For Tuesday, 11th of October. Hope you had a good evening. Getting down to business then, and first of all, just recapping some of the market moves we had yesterday, and starting off with crude, because I can see oil's just making another slight push here to the upside. If I make my chart a little bit bigger here, so the high print from yesterday, 51.60, and you can see we had a pretty sizable rally yesterday. On the back of some comments, well, really out of the two major players, around a 4% rally in yesterday's session. Ultimately, that did lift the energy names in the S&P 500 and helped all three major indices close into positive territory. But a pretty aggressive move, as you can see on my chart. So just recapping what the current state of play is here. Firstly, out of the Saudis, you had their energy minister sounding optimistic that a deal between major producers would be reached in that next official meeting on the 30th of November in Vienna for OPEC. But grabbing a lot of the headline attention was Russian President Putin, who said that in the current situation, we think that an oil output freeze or even an oil production cut is likely to be the only right direction to maintain the stability of the global energy sector. And that Russia is ready to join the joint measures to cap production, is calling for other oil exporters to join. So it's quite interesting. Unlike a lot of countries, Putin obviously has quite an overarching amount of power in Russia, and therefore when he speaks, unlike other politicians in other Western worlds or economies, he does tend to carry a bit more punch, particularly when talking about oil. This in addition, of course, to the energy minister. So it was more the cooperation, if anything, between the two biggest players, Saudi and Russia, that caused the majority of that upward move throughout the session. Looking at crude oil, I think this was something Piers was sharing with you guys yesterday. You can see this is a daily continuation chart. Where we are at the moment, well, I think we've just about... we're within range of that high print that was seen in the summer of this year in June, around the 9th of June, 51.67. So that's kind of technically where we are at the moment, and you'd have to really go back to... well, let me just change my time frames. It's really since July, summer of 2015 when we were last above these kind of levels. You can see that price activity there. And so sitting above $50 at the moment, really, although there's been a lot of toing and froing of whether or not they can in fact get these quotas in place. Obviously, they've only got around another, I guess it's about 7 weeks or so to iron out the details. But for the time being, technically, if we break above that kind of summer high, then obviously then that starts to open up more towards 55, and then ultimately the summer highs that we had from last, or 2015, we're looking at around 62.5 type levels. I did hear on the Squawk this morning that some of the Saudi and Russian officials are actually meeting each other, so I would remain vigilant for some headline information coming out on the Squawk. Probably looking for just a continuation of the pattern from yesterday. I think the trend certainly has been upwards in oil, and I'd be following that trend for the time being. Likewise then, as I said, that was really the underlying catalyst for the move higher in equities yesterday. The energy sector did outperform in terms of the S&P breakdown. You can see really since the European morning we moved higher, and then we kind of gravitated throughout most of the US session before some profit taking was seen overnight in Asia Pac trade. One of the other things as well that's helping lift some of the sentiment has been, well, the debacle that happened with Trump over the weekend really has resulted in the latest polls, and one of the ones that's been commented on in most of the press this morning is the NBC News Wall Street Journal poll that came out last night, and that has Hillary Clinton opening up a 14 percentage point lead against Donald Trump. So the margin has increased substantially. And then just to make things worse for dear Donald, the big news has been that a damaging blow to the Republican candidate's chances was the announcement from the House Speaker Paul Ryan. The top elected Republican in Washington has said he will no longer campaign or defend Trump. I still even though the guy is literally imploding, I think you can't discount him still at this point, but certainly in terms of polling, if you were monitoring that as a guideline, then we're back at some of the widest margins we've been in quite some time, and Paul Ryan, I think, is a significant step, the most kind of senior respected person within the party pulling the backing for Trump. So we'll see. I mean, does this then start to alleviate any of those uncertainties that were creeping in on the market or into the market of late, given the resurgence of Trump in the polls only a few weeks ago? Does this now open up the kind of freedom for the markets to, when you think about it, the Fed not really hiking rates until later on in the year, so we have, if anything, despite hawkish commentary, a combination of policy, at least for the time being. And then if you start to remove some of the headline political risk, although there's still things in Europe like Italy to come, certainly the US elections was a big headline or a big headwind coming in the weeks ahead. If you remove that, then does that start to give the market a bit more appetite for risk? Elsewhere, a quick look in the FX markets. The dollar continues to firm up. We're now up around 1/3% this morning in the dollar index. So you can see here in the top left my charts, both major pairs trading lower on session. For euro dollar, just keeping an eye on the Friday low that we printed when we came in on Friday morning. That was around 111.35.5, so we've pretty much touched that to around half a tick this morning, so I'll be watching that level. And then cable, well, really it's a continuation of the, ever since we had that, what was the previous, you can see there, I've got it still marked up, 28.06, that previous Brexit low. Then we had the algo flash crash, and since then we continue to track lower, sitting at the 123 handle this morning, which coincides with S2. I guess below here, you're kind of looking at big figures, so the 2250, which kind of corresponds with the blip that we had on the low print on Friday morning as well. So I'll be keeping an eye on the dollar and cable. The trend still for the time being to the downside. One thing though, one chart just to kind of take some of the sheen off the positivity, is make of it what you will, but I did see, well, let me just say, when I was looking at those charts, let me just quickly flick back. That was the euro level I was just referring to from that low from Friday, if you can see that now. And then in terms of cable, as I said, they had the big algo-driven crash, and then there was that the low on Friday, and now we're at 123. I'd imagine that 2250 is kind of next downside target, and then to the round figure, should we make another push on the downside. So yeah, I was going to say one thing that I did see last night, which it's always worth just taking a look and being aware of these patterns that are forming in the market. But there was a chart that a chap at Citigroup put out. It was actually at the end of last week. And what you can see here is a chart of the S&P 500 today overlapped with the S&P 500 on the 7th of October 1987. Now I'm sure you can remember what happened there. That was when the index dropped, I think it was 22.6% in a day. You know, you think these moves are big that you're seeing at the moment when an index is down 2%. This was 22%. And if you look at the chart here, the price activity is eerily reminiscent of what happened And look where we are right at this present point in time. Ripe for a big downward move if you were to look at these historical trends, and timing-wise as well. The reasoning that the Citi analyst is pointing out is a couple of things. He put out a note issued on Friday, was looking at the heightened concern about Europe and its banks, i.e. Deutsche Bank being the main kind of focal point, the most polarizing US presidential election in modern times, more reports circulating about central banks in Japan and Europe removing of economic stimulus, and finally some peculiar market moves. A 16% move in oil prices within a week, a 20 basis point shift in US 10-year yields in 5 days, a $90 move in gold prices in 9 days. So kind of erratic and highly volatile price movements in various types of assets. And these are a couple of things in which this strategist specifically is looking at. A support level to watch for the S&P 500, he states, is 2119. That's the critical floor below which traders are unlikely to allow the index to fall. And if it breaks support, we're looking for a new floor. So let's just have a look at that. I've not actually marked that up on a chart before. Let's have a look and where that sits in the grander scheme of things. So 2119. So you're kind of looking really, well, you can see, let me clear this up. So 2119, that's kind of the base of that price movement that was seen, that kind of supports the recent move. But then looking back, you can see that May or early June, and then obviously we had the Brexit, 23rd, 24th. That was the capping high. This looks very similar, actually. Do you remember that gold chart that we were looking on $1,300? Well, let's just have a quick look at that. I think I still have that actually marked up. So I can just actually bring it up on here. Give me one moment. Yeah, so if you look at that, this is gold prices on a daily continuation. If you look at 1300, you can see that big move lower that we had when it eventually broke. And you can see how we had that line was resistance back in May and then June, and then it took the Brexit to power above, and we remained above there until the break back lower more recently with the more kind of hawkish turn with the Fed, and the dollar's continued gains. Now looking at the S&P, okay, I've just been informed that the chart. Okay, so looking at the gold chart, this is what I'm looking at. So this is gold. You got the May, June high, the eventual Brexit break. We remained above that level until a firm downtick on the downside of 1300, and then we've powered back lower, and it was a very quick run from 13 down to 1250 area. Only took, well, really it was about 2 to 3 days. Now looking at the S&P, similar price activity. You've held in June, resistance. Then you had the Brexit, big move to the downside. We've rallied since then. Obviously, central banks stepping in the wake of the surprising move of Britain to vote to leave the EU meant the likes of large-scale easing from the Bank of England and other commitments from other central banks, all their hands being shackled in terms of the Fed rate trajectory path. So then we've rallied, and then we've held support so far on that 2019. So although we're away from that at the moment, I think the Citi strategist does make some sense in terms of that's a really big level on the downside and the slightly, I'd say, short to medium term that we need to be mindful of. And if you look at the price activity here, we certainly are starting to narrow a little bit in this range that we've had more recently. You could argue that at some point here we're looking out for a break in either direction, and then that 2119 will be interesting to the downside. Otherwise then, let's just move on with what to look out for the session ahead. Pretty quiet overall in the morning. We've got a major release coming up a bit later, but first off, we've got in 12 minutes time the IEA's monthly oil market report. You don't really get an immediate move on the back of that, but certainly in the context of oil being in focus with the big move to the upside yesterday, this ongoing kind of OPEC cup of production that's circulating, I'd be definitely keeping an eye on the supply and demand side of their latest report. So that's coming out at 9 a.m. Then the major European data of the morning will be the ZEW economic sentiment. A quick look at that chart on trading economics. So again, this is the measurement of the level of optimism that analysts have about current economic situation and expected economic developments over the next 6 months. So the reason why this is one of the biggest economic data pieces that come out of Germany and as such Europe is because it's a forward-looking indicator. So for the next 6 months, and this is specifically analysts' insights. So you can see here we had the collapse in the reading. You can see we were up at literally the most highest level in some time prior to the Brexit, and then a reevaluation of the outlook going forward, and we've stabilized at pretty much a flat line at 0 for the last 2 months. Now the median consensus today is for a 4.3 reading, which obviously puts us back at the February level. So we'll see whether that materializes. Probably any negative reading, so against market consensus, could draw some attention if the outlook going forward continues to remain pessimistic from a European point of view. Otherwise, looking at the afternoon, it's particularly quiet again in the US. You've got the NFIB small business optimism, which is, I'd say, third tier data. Same case with chain store sales and Redbook. And you've got the Fed labour market conditions later at 3 o'clock. Speakers may be more interesting. Bank of England Saunders, so any cable traders. I know I have seen quite a few already getting in on some of this pound weakness. Just be aware if you're in a trade or thinking of initiating one, you do have an MPC member speaking at 10 o'clock. Now this is a Treasury Select Committee hearing, which most normally means that this is purely a reiteration to politicians rather than anything new or groundbreaking from a Bank of England official, but nonetheless just be mindful of any headline risk. Then later, Fed's Kashkari and ECB's Mersch just after European close. Obviously yesterday, although we did have some decent market moves in the likes of oil, obviously volumes were a little bit impeded by the fact that it was Columbus Day. So US markets open as per normal today. However, I do believe it is Yom Kippur. So again, participation from Jewish participants in North America could lead to still slightly lighter volumes than might be normal. Okay guys, that's pretty much your briefing for this morning. So enjoy the session. Any questions, then please just fire them in the chat. Enjoy your day. Thank you.